Hello and welcome to the macro bit for the end of the week that began on September the 18th, 2017. I've done a lot about the Fed already this week, and I really sort of recommend you have a look at Tony and my piece that we did around it. It will give you a very good synopsis of exactly what it means for us here in Australia, because it will have an effect, and it's not this current month or in October, it's what's going to happen in December and also in 2018. You do need to be aware that it will likely filter through to wholesale funding of our private banks, and that's why the Fed is so important to us here in Australia, not just for the US and for the globe. It does impact you. So I recommend you go and have a look at that. But what I do want to concentrate on is actually looking at our central bank. There wasn't a huge amount of actual economic news. We did see Westpac's leading indicators. It's normally not the greatest survey to sort of really drill into. We saw new car sales as well. They were fairly flat, which is what you would expect. But what we did have is the RBA minutes from this week's meeting, and we also had Philip Lowe talking over in Western Australia, and it's his speech that I really want to concentrate on, because it's actually a really good summary of what's going on, probably from an Australian-centric point of view versus what we're talking about with the rest of the world. And what I mean by that is that he very much alluded to that Australia is different. We were different during the GFC. We didn't have to go as hard in cutting and going into hugely accommodative monetary policy stances. We didn't have huge amounts of declines in GDP. We obviously didn't enter into any form of recession. We didn't have the unemployment levels that sort of spiked up in Europe and also in the US. And we didn't have run-ons in their banking system like they did in Europe. So we were not like them. Yes, we cut interest rates. Yes, we've got the lowest interest rates we've had in our history at 1.5%. But it's certainly not a runaway accommodation period like you've seen in the US. And even with a further rate rise going on possibly in December, it would mean that their rate band would move to 1.25 to 1.5%. So they'd just be touching us in terms of where they're sitting. Look at Europe, they're still basically at zero. It's the same with the BOE, and they were out this week talking hawkishly about moving rates, but they're also below 1%. Same with the Bank of Canada. So we are different, and he alluded to that. He very much talks about the idea that interest rates are very, very hard. In fact, I always use the word sledgehammer. They are a blanket operation, and they don't target the areas that really need to be slowed down, because they also hit the areas that if they were to slow down would create quite the tightening. And we know about household debt, and he alludes to that, very much talked about it in his speech, the level of household debt, that a really sharp increase to get back towards what he believes the neutral cash rate is, which is 3.5%, and that is falling, would be quite hard for our economy to take, because it would really, really hit household debt and would slow down consumption. It would also put a lot of pressure on inflation. It would put a lot of pressure on also employment, which is actually starting to grow at quite a reasonable rate of numbers, and we've been seeing that. So I think that needs to be put into where I sit here and where I start. So it gets back to what happened on Tuesday with the minutes. All of this was mentioned. They do talk about the fact the economy is growing at a reasonable clip, that we're seeing employment materializing, that you're actually seeing growth materializing as well. But there were big caveats in that. They talk about the Aussie dollar, they talk about wage growth, and they do talk about a very delicately poised scenario with households. And that is where they sit. And that's why, from my perspective anyway, although there are players forecasting rate rises in 2018, I still don't see it. Maybe one could happen next year, but in the main, I don't think that Philip Lowe needs to do it. And he's alluding to that as well, and the fact that he has other levers that are coming in naturally through the market to help him in that scenario. And that's what this week was about, is that the Fed may actually do that for us. And we've seen out of rate cycle rate rises from the big four banks off the fact that their wholesale funding increases. And we know that's going to happen in 2018 and 2019. So that may be another reason why rates don't move. So it's a really interesting week, and that's why I think it's probably one you need to focus on, and one that you need to really sort of be aware of from your investments point of view as well, because it does therefore affect the big four banks, the pillars that are the ASX around those big four, and what it means for their growth as well. So really interesting week. It's certainly something I expect to watch over the next quarter, because leading into that December meeting for the Fed, it will all be about where rates will be in 2018 and the effect that's going to have on the market.
Introducing the InvestSMART Small Companies Fund. The InvestSMART Small Companies Fund is now open for investment. Managed by our equities team at Intelligent Investor, the fund will use the same long-term value investing philosophy that has provided the team's track performance to date. Often overlooked by the broader market, the fund will offer investors diversification across a range of 10 to 25 small companies. To protect our investors, the fund will be closed when necessary to ensure the fund stays at an optimal invested level. Visit our website for more information or get in touch with our team.